the real excitement comes when you start using them in a trading strategy. Now, I'm about to reveal 3 order block strategies that can take your trading to the next level. Strategy number 1, multi-timeframe confirmation. For this first strategy, start by finding an order block on a higher time frame. In this example, we're using the Bitcoin USD 4-hour chart. At a glance, we can see 2 significant price movements. The first one is moving upward here, and the second is moving downward here. Both of them also have inefficiencies. So, we have 2 possible order blocks, a bullish one and a bearish one. However, let's double-check if these 2 potential order blocks are actually valid. For this bullish one, the price did move upward with inefficiency, but it didn't form a clear break of structure. Plus, the price retested it afterward, so it's no longer unmitigated. For the bearish order block, the price clearly formed lower lows, creating a break of structure, plus it's unmitigated. So, based on our analysis, only this bearish order block is valid. Once you've identified the correct order block, the next step is to wait for the price to retrace back to that order block. The moment the price touches the order block, we now move on to the next step of the strategy, which is confirmation. We're trying to confirm whether the price will actually bounce off this order block. To do that, we switch to a lower time frame, like the 15-minute chart. On the 15-minute chart, we're looking for any signs of bearish momentum to prove that the price will reverse from this order block. You can use any type of confirmation tools, whether it be an indicator like the MACD, finding a bearish candlestick pattern, or spotting a change in market structure. Basically, anything that confirms that the price is likely reversing from this level. Now, my favorite confirmation tool is the bearish engulfing candlestick pattern, as it's simple yet effective for giving early signals. A bearish engulfing pattern occurs when a smaller bullish candle is immediately followed by a larger bearish candle that completely engulfs the previous one. This indicates a potential reversal from bullish to bearish. Once you spot it, you can open a sell position right after the pattern has formed. Then, place your stop loss slightly above the order block and set your take profit at 2x the size of your stop loss. As you can see, this strategy can lead to some solid profits. Here's a cheat sheet that you can use when trading on multiple time frames. If your high time frame is the weekly, use the 4-hour as your low time frame. If your high time frame is the daily, use the 1-hour as your low time frame. If your high time frame is the 4-hour, use the 15-minute as your low time frame. If your high time frame is the 1-hour, use the 5-minute as your low time frame. And that's all you need for strategy number 1. Strategy number 2, inducement traps. An inducement trap is a specific setup that involves a minor key level forming near a major order block. Take this example. We have a major order block forming below and a minor key level forming above it due to multiple rejections. This minor key level is also referred to as an inducement. The strategy is called an inducement trap because in many cases, the price will break this minor key level only to retrace to the major order block before reversing back up. Traders who bought at this seemingly obvious key level, expecting a bounce, would often get stopped out instead. So, if you spot a setup where there's a minor key level sitting above a major order block, you can cue a buy order in the middle of that major order block. This way, your buy order only gets triggered if the price touches the order block, offering you a high reward trade. But if the price doesn't reach the order block, that's perfectly fine because no position was opened. While this may seem like a random and specific pattern, it's actually more common than you might think, and there are logical reasons to why this setup works. First, let's understand that large institutions want to enter the market at an ideal price, but due to their massive capital, they can't do so without moving the price. Unlike retail traders who can enter positions easily, smart money couldn't enter positions that easily, as their large orders would push the price up, causing their average entry price to be higher. So, in order to enter at a lower price, they use inducement levels. After entering the market and forming an order block, they push the price back down to that order block by trapping traders who bought at inducement levels expecting a bounce. This is effective because traders often place stop losses just below key levels, meaning just a little bit of selling pressure could trigger these stop losses, which in turn leads to more selling. This allows smart money, which entered at the previous order block, to re-enter at that price, driving the price back up. So that's the basic logic behind why this pattern works. Now, let's look at a real example. In this chart, the price moves significantly upwards with an inefficiency, followed by a break of structure, making this a valid order block. After this upward movement, we identified an inducement zone as the price formed multiple rejections at this support level. Now, because we have a setup where there's a major order block below and a minor support level near it, this could be a potential inducement trap. This means the price could break the minor support level and retest the order block. So, we place a limit buy order in the middle of the order block and wait. As you can see, the price moved downward, broke the inducement level, and triggered our buy order at the order block. After the order is triggered, we place a stop loss just below the order block and set our take profit at 2 to 3 times the size of the stop loss. You could also target the inducement zone as your take profit. As you can see, this trade turned out to be profitable. Strategy number 3, breaker blocks. In the very first part of the video, I mentioned that order blocks are typically a one-time use, but there's actually a way to take advantage of order blocks that have been broken. This strategy is called breaker blocks. What is a breaker block? A breaker block is a previously valid order block that has been broken. Once an order block is broken, the price may retrace back to that level, and it can act as a potential resistance level, where the price may reject this level. This gives us an opportunity to short at the breaker block. Keep in mind that breaker blocks are typically one-time use. After the price breaks and retests the level, their effectiveness is usually done. Let's break down this chart example. In this chart, we can see the price move significantly upward, paired with inefficiency. We also see the price made higher highs here, so we can draw an order block at this candle. But then, the price moved downward and actually broke the order block. This move also created a change of character as the price broke below the previous lows, indicating that the trend has shifted from bullish to bearish. Now, as the price retraces back toward the previous order block, it can now act as a potential resistance zone. This is a prime area to open a short position. Then, place your stop loss slightly above the breaker block and set your take profit at 2 times the size of the stop loss. And as you can see, the price rejected this order block, hit our target, and resulted in a nice profit. Now that you know these strategies, it's time to take action and start using them in real trades.